Hello friends, a very warm welcome to my channel. In today's video, we are going to do the analysis of an interesting small cap company called Ksolves, which is into IT sector. This stock has been very popular as it has given a very good rally in the recent times, and who had invested earlier had made good money. But people are still wondering whether it's worth entering this stock at these levels, and people who are already holding the stock are confused whether to book profits or to continue to hold. So we'll discuss the basics of this stock, like the business. We'll understand the company's performance. We'll also see what are the risks involved in investing in this company and decide at the end whether to hold this stock or book profits. If you're new to the channel, please do subscribe and hit the bell icon. And if you are not a part of our Telegram channel yet, do join today by searching my name on Telegram, as we discuss daily morning the market analysis and lot of interesting views and news on our Telegram channel as well. So this will be the flow of our discussion. We'll start off with understanding the business model in brief. We'll look at the performance of the stock in the last few months. We'll see the financial performance in the last few years. We'll understand why the stock has given such a big rally. We'll understand what is the outlook of the management going forward. We'll see the valuations of the stock. We'll see what are the risks involved in buying this stock or holding this stock going forward. And ultimately, we'll form a view on the stock. So this is the business model of the company. Almost 97% of the revenue is from services and only 3% from the products. So in services, it's a software development company delivering software development services as well as consulting services. In the product segment, it works on products like Adobe Magento, Odoo and Salesforce. So these are the different technical capabilities of the company. The company works on products like Odoo and Magento, big data, then enterprise solutions in Java and Scala, AI and ML, DevOps. A major chunk of revenue comes from Salesforce and mobile and web applications. There are more than 400 people working for the company. It's an 11-year-old company. They render services and have clients in 25 plus countries. And it's a good thing that they have almost 84% repeat business, and top 5 clients contribute about 33%, which is slightly risky. If you look at the chart in the last few months, the stock has given a very sharp rally. It was consolidating for a very long time in the range of somewhere around 350 to 400, and later it gave a sharp rally and crossed about 800 now. In fact, 900. Now the stock is hovering at the range of somewhere around 850 to 900. So as you can see, it has given a very sharp rally in the recent few weeks, and now the people are wondering whether to continue to hold or book profits. When you look at the financial performance in the last 5 years, it has been spectacular. From a 5 crore turnover in FY19, the company has grown to almost 77 crores of turnover in FY23. In terms of EBITDA also, it has done just a 1 crore EBITDA in FY20. It has gone up to almost 33 crores in FY23. The margins have increased from about 6 to 13% to almost 45%, and now they are hovering at somewhere around 42%. In this sector, keeping such high margins at EBITDA level in the long run may not be so practical. Now, what are the reasons for the rise in the share price? The excellent performance of the company in terms of bottom line. It has in fact shown more than 100% year-on-year growth in the last 3 years, and the margins have also spectacularly expanded, and in terms of industry levels also the margins are the highest for this company. How does the management plan to grow going forward? Is they want to continue their hybrid delivery model, where they want to open offices on site also. They will not just outsource work to the Indian team, they will open on site offices and work there. They will continue to target the enterprise customers. The company is expecting that, although not 100% year on year, but the company will try to maintain very high growth rate. And in terms of billing per employee also, they will try to further increase the billing per employee by targeting higher value projects. Now, if you look at the valuations, the stock was getting valuations of somewhere around 6 to 8 times in the recent few months, which has shot up to almost 14 times presently. So this kind of valuations in this sector are highly unsustainable. Unless the company continues to maintain such high growth in future, which may be difficult for them, as when the company is very small, it is easier for them to show these kind of results. But as they start scaling up, showing this kind of growth rate may be slightly difficult going forward. Now, what are the risks involved in somebody who is already invested in the company or who wants to invest in this company? Is the past track record of growth rate. It may or may not be sustainable in the future, and these kind of margins of 40% plus at EBITDA level are also difficult to maintain as the company scales up its operations going forward, as they are going to open on-site offices, and here also the hiring will be more, the fixed cost will be more, and they will be bidding for bigger projects. So maintaining these kind of margins and going in the further months may or may not be sustainable. In terms of valuations, the stock looks stretched now, as it's trading at somewhere around 14 to 15 times of revenue. And there is a slight dependency on the promoter in this business. So that also comes as a risk for this company. And over a period of time, in the last few years, the promoter's holding has been decreasing. although we don't foresee an immediate decrease in the promoter holding going forward, but if at all there is, then that could be a risk for the investors in this company. Now, after looking at the business model of the company, the reasons for the rise, the financial performance, valuations and risks, what is our view on the stock? If you're already invested in the company and if you have made very good money in the recent times, it is also important in the stock market that you protect your gains. So it is always advisable to put a trailing stop loss, because in case the company doesn't perform so well going forward, the valuations may get normalized and the stock may fall. So you should protect your gains by putting a trailing stop loss if you are already invested in the stock. For new entrants at these particular valuations, the risk reward is not in your favor, as a re-rating of the stock has already happened depending on the performance. So it is better you stay away from the stock for a while and wait for the correction and the valuations to get normalized before you enter. So this is about Ksolves. I hope you like the video. If you like it, hit the like button and share with your friends. If you have not subscribed to the channel, please do subscribe today, and don't forget to join our Telegram channel. If you want me to make videos on your favorite stocks, do comment the name of the stock in the comment section. I will consider it for the upcoming videos. Thank you for watching and have a wonderful day.